Happy early Valentine's Day. It's Sunday, February 13th, 2022. I want to give you guys a few different videos about a couple of things. But before I go into that, I'm going to go into this very quickly. I'm not an entertainer, I'm a trader. I say that because if I'm not dressed up in a suit, if I didn't do my hair, if I didn't shave, understand this. I'm a trader. I'm not an entertainer. I'm not here after reviews. I'm not asking you guys to subscribe. I'm not asking for likes. I'm not on Twitter asking for followers. I'm not on Reddit asking for followers. The same thing. So I don't even plan on doing like a nice background, nice suit to dress up nice, unless I could see that I can make at least 10,000 a month from clicks, from views, or from something else. If I'm not getting $10,000 a month, I have no interest. I'm just being honest with you. How many people are just straight up and honest with you? I'm being straight up and honest with you. So I'm on Twitter. I'm getting some traction. And just like when I came on Reddit, I was hoping to get at least $500,000 salary and a chance to make millions. So I don't want a little bit of money from you guys. I don't want someone to pay and ask me to train them, because I've already had people offering me like $1,000. So I'm not interested in $1,000 or a couple of $1,000. I'm interested in millions. So for me to get millions, I either need millions of followers, millions of views, or I need an important person to see what I can do and understand that I can bring value to them. Now, if I can't get that job, maybe at least I can get like 5,000 for a week of consultation to a company, or maybe I can fly out to Facebook for 50,000 and tell them how metaverse was a disaster. So that was that. So I don't want to go too much into that, but since my last videos, people ask me like, why don't I do this more professionally? I'm not an entertainer. I'm not here to entertain. I'm here to give you guys over on Reddit, because even on Twitter, like, I'm not big yet. I'm gaining some traction, but my main thing on these videos is not for YouTube, is not to get subscribers, is not to get likes, it's to answer questions that I'm getting at Ultimate Traders. Now, I do get some questions on Twitter. I really don't get too many questions on YouTube, but these videos are mainly to answer questions at Ultimate Traders on Reddit. It's Nathan from Queens. So going into a couple of these videos, the most important video that I could do right now is the interest rates, inflation. CPI this past week, that's inflation that measures the cost to live, is going up 7.5% from January of 2021 to January of 2022. What that means, and right now the federal funds rate is at 0.25. So generally, in the past, usually our federal funds rate is between 3 and 5%. What that tells you is for the last several years, our interest rates from the Fed is very low. Now, mortgage rates are already going up because it goes by the T-bill, by the Treasury, the U.S. Treasury. So normally, right now it's about 2%, a little bit higher than 2%. That's what normally the banks go on. But at a last resort, they borrow money from the Fed. So they go by the federal funds rate. So when the federal funds rate goes higher, everything else goes higher. But a lot of the mortgages, a lot of the loans go by what the T-bill is trading at. The 10-year T-bill, the 30-year T-bill. But we're not going to go into that because I don't want to confuse anyone. I want to make this as simple as possible. So right now, we're at 0.25. Now, before the CPI came out, I was typing in Ultimate Traders. I've been telling my generals on my team, I have about 30 people now. I actually reduced my head count. So people that help donate to me, I reduce them because the market is not easy to make money. So once again, I'm not here to make small amounts of money from you guys. From paid clicks, from views, paid stuff. I'm not after that. That is not my end game. I don't even want thousands. I want the possibility to make millions. I don't want people to see why I'm asking for millions. You have money managers making Kathy Wood probably made 250 to 300 million dollars. Chase Coleman with Tiger Management made over $3 billion last year. Steve Cohen makes like $2 billion. David Tepper like $2 billion. But we're not going to go over that. So once again, Fed fund rate is at 0.25. Before the CPI came out, I was typing and writing, I believe we're going to have between 3 and 6 rate increases. Between 3 and 6 at 0.25 each time. And after they raise it, the Fed is going to take a step back and look and see what's going on with inflation. Has it changed? Has it not? What's going on? Now, after that CPI and last week, employment was very strong, meaning that money is flowing in the economy. So with the pandemic, it was like a perfect storm. Meaning because of the pandemic, money was flowing everywhere. Interest rates were going to remain low because Fed Chairman Powell wanted to try to keep people with work, keep people with job, so he remained low on the Fed funds rate. Money stimulus was flowing everywhere. Expectations from companies were very, very low. So it was easy for companies to beat. It was easy for companies to borrow money. It was easy for people to get money on loans. Right now, the U.S. household debt is $16 trillion. $16 trillion at an all-time high. So if interest rates go up, it's going to be harder and harder to live. But what I want to do in this video, I want to tell you in your companies, because anyone can just say that. But what does that mean to you? What does that mean to me? What does that mean in terms of our companies beating expectations? Because I'm trying to tell my trade team, I'm telling the people, ultimate traders, don't worry about what the other money managers tell you. Don't worry about the other furrows, which is financial gurus, tell you. This is what I tell you. So the only way to combat interest rates, like interest rate hikes, and the only way companies can keep going up is if they beat by a lot. So right now, earnings reports are still coming out. It's February 13th. The fourth quarter reports kicked off the third week of January. I'm still going to grade overall a 70, which means that companies are beating expectations, but on a very, very low margin. So what that means is like 3 to 5%. When they beat, they're beating by like 3 or 5%. So if a company was supposed to have $100 million in sales, they came at $103 million. Did they beat? Yeah, but barely. If a company was supposed to make $100 million, what did they make? They made $103 million. So did they beat? Yeah, but not too much. And why grade as 70? Because a lot of companies are just meeting that, meaning they're not beating bottom line how much they make. They're not beating top line how much they sell. They're just barely meeting it. And what I feel is going to happen is the first quarter ends March 31st. The first reports are going to come in the third week of April. And instead of a 70, we're going to have a 60 or 65 grading score. And to me, what that means is companies are meeting bottom and top line, not beating, but in general, they're just meeting. They're not beating by 3 to 5%, they're just meeting. Now, if companies are missing on top and bottom line, which to me is a grade score of 50, then the market goes a lot lower. But as it stands right now, I believe the NASDAQ should be around 13,000 and 13,500. But now I'm going to explain the most important thing, interest rates to you. Now, these two companies that I'm going to use, I'm disclosing I'm short. I'm short. I have a bear position via puts. So I don't actually have a short position on the stock. I have options called puts, betting that the stock is going to go down. Now, I have close to 20 different puts. I could have used any company. I just chose these companies. But you know that, just so you know, close to 99% of companies that trade in the United States is borrowing money. And most of these companies that are borrowing money do not have the cash available to pay off the debt if the rate rises. What they do is the American way. When a principal comes due, like when you're about to have to pay the big money amount, they just refi. They just refi and just extend it. Extend it to a later date. Extend it to a later date. So every 6 months or a year, a lot of these companies are just extending the loan to a later date. Now that's okay when you don't have the federal government going against you and raising up high. So right now, remember I said right now, Fed fund rate is at 0.25. When this is all said and done, I'm thinking because the CPI was on fire, employment is fire, that we're going to go from 0.25 to 2%, maybe more. So let's just, because we're going to use solid numbers, and these are estimates. Well, some of these numbers on Boeing and Carvana are not estimates. They're rounded off numbers to make it easier for you. But so you know, Nathan from Queen doesn't give you speculation, doesn't give you momentum. I give you facts, but I'm rounding off some of this stuff to make the numbers easier for you to understand. So the main thing with this, because I have seen other videos with people explaining interest rates and the effect on companies, but I have yet to see one where someone gives you examples of what's going to happen to the companies that we trade. The companies that we trade once we get a rate. So to make this easy, I'm going to say we're going to get an increase of 2%, and I'm going to use those two examples, Boeing and Carvana. Now, Boeing is a $124 billion company. $124 billion company. Right now, as it stands, they have close to $100 billion in debt. Remember, I'm rounding it off. So if you want to say something, oh, Nathan lied or Nathan, I'm rounding it off. So they have close to $100 billion in debt right now. And remember, like I just said, these are, it's not estimated, it's rounded off to make it easier for you to understand. So Boeing in 2021 lost $5 billion. Once again, this is rounded off. So Boeing lost $5 billion. Of the $5 billion, they lost $3 billion in interest. So in interest is costing the company close to $250 million per month. $250 million per month. So they lost $5 billion, $3 billion interest that they lost, okay? That's how much money they're paying interest, $250 million a month. So if rates increase by 2%, just 2%, what is the likelihood of them to be able to pay or to renew bonds? They can't. That's going to be close to 100 million more per year. And Boeing has close to 600 million shares available. So that's going to be about 30 cents per share. And they're already missing estimates. So can you imagine so that'll be another 4 or 5 cents per quarter? No, it's actually going to be more, because if it's 60 cents can you imagine another 15 or 20 cents every single quarter? Quarter. They're missing by 15 cents added, and it's not by production. That 15 cents added per quarter loss is going to be because of interest. So when you were expecting a company, now sales could be the same, but bottom line is going to change because they're paying more interest. So if you expected a company to make $1, all right, and now they're going to go from making $1 to making 40 cents, they missed. And what's worse is, as interest rates rise, if the stock still stays high, what is a company going to do? It's going to sell shares. It's going to sell shares because they can't pay the debt. How can Boeing lose $5 billion a year, pay $100 billion in debt? They don't have the cash available. Now, the only company, there's a lot of companies, but the only company that can do whatever they want to do is Apple. Because Apple has enough money in cash and they're sitting in their bank that if someone came and said, pay off the entire debt right now, Apple can do it. So if your company has enough cash to pay off the debt, If rates rise 2%, that's not going to do anything. So that was through Boeing. Boeing, $124 billion, close to $100 billion in debt, $5 billion in losses, $3 billion in interest a year, $250 million a month. That slow interest, 2%, might cost them. It's going to cost them a good amount of money for the whole year. So that was Boeing. And the next one is going to be Carvana, okay? Because Carvana, I have puts on both of these companies. I'm just going to do these two. So Carvana is about $13 billion, right? They're borrowing, in a year, close to, because this is a roundabout. They didn't do a full year yet. But their cost on interest is not $3 billion like Boeing. Their cost on interest per year, and you can go to the SEC. I'm getting these, this is not FUD, I'm getting this straight off the SEC. Most of the companies, like I said, in the United States, unfortunately borrow money. So their cost, Carvana, is close to $200 million a year. So that's $15 million per month. If rates rise 2%, that's going to cost them about $4 million, maybe a little bit more than $4 million more per year. Carvana has 80 million shares. So that means the 4 quarters is going to be a little bit more than 20 cents. So each quarter report, that's 5 cents miss. 5 cents or a little bit more. So imagine, because Carvana is already losing money and they're already missing. Actually, they beat 2 quarters ago, but they're already losing money. So imagine Carvana was supposed to, I'm just making it easy. Let's just say Carvana was supposed to break even. All right, analysts had Carvana breaking even. Now, instead of Carvana breaking even, Carvana is losing 5 cents a share. What's going to happen to the stock? Everything else remained equal. Interest rates rise. This is what happens. This is why you can't have interest rates rise with growth stocks that don't have money. Or Boeing. Boeing is the rich man's AMC. I won't go into that. But these are 2 companies that have a bunch of debt and can't pay it off unless they sell shares. And that's going to be another video. So if Carvana, and that $4 million more per year for Carvana is big. It's big because Carvana does not make money yet. So when you make a lot of money, $4 million doesn't matter. But they have 80 million shares. So when you divide the 80 million shares to the 40 million, you get close to 20 cents. These are round to make it easier. 20 cents, 4 quarters, 5 cents a quarter. So you tell me, if your company, all else remains equal, misses by 5 cents more every single quarter, how is your company going to do? So that's the first video, guys. If you have a question, let me know on YouTube, on Reddit, or on Twitter.